In this chapter, we will look at problem 12-24A. In requirement 1, before we start, please read through the problem. Please make sure you tried this problem on your own and then take a look at this answer key. But Loisel has contributed assets and liabilities to the partnership. So we will debit store equipment in the partnership, the new partnership. Merchandise inventory of $30,000 will be debited in the partnership. Accounts receivable will be debited for $10,400 in the partnership. Prepaid expenses, again, $2,700 debit. Credit accounts payable in the partnership, $24,000. These are all the items that she contributed. So her capital balance is credited for $43,100. Since Randall gave cash, he will debit cash of $43,100 and then credit Randall capital, $43,100. One thing to remember are all of these accounts are in the partnership, and neither Loisel or Randall keep ownership to these specific assets. They are now the partnership's assets and liabilities. Their claims on the assets are kept track of in their own capital accounts. But if Randall leaves, he can't say, I demand my cash back. No, you gave your cash to the partnership. It is now the partnership's cash. In requirement 2, they want us to prepare a balance sheet immediately after the point the partnership is formed. Well, we would look at those prior journal entries we just made. You could set up T accounts. Those are the only assets, liabilities, and capital. There's no revenues and expenses at this point that the company will have. So the assets, the cash would be at $43,100. That's how much Randall put in. Accounts receivable would be the $10,400, inventory $30,000, prepaid expenses $2,700, and the store equipment $24,000. So the total assets in the business $110,200. Loisel also contributed a liability of $24,000, so the accounts payable is in the partnership now, and it's the liability of the partnership, $24,000. And then each partner's equity will be shown. Loisel's capital balance of $43,100 and Randall capital $43,100. When we add those together, the total partner's equity is $86,200. So when we did sole proprietors, you only had one capital account. Well, when you have a partnership, you have more than one owner. So each partner has their own capital account. We add the accounts payable, the liabilities, to the equity to get total liabilities and partner's equity equal to total assets. So even in a partnership, assets have to equal liabilities plus equity. The major difference between the partnership and the sole proprietorship is the way we present capital. That's it, because there's more than one owner. In requirement 3, they want us to journalize the closing of the net income to the income summary and the distribution of that net income to the owner's capital accounts, and also the closing of the withdrawals account. And we already defined that the company made $79,000 in net income. 60% of that goes to Loisel. So 60% of $79,000 will be credited to Loisel's capital account. Randall will have the other 40%, $79,000 times 40% or $31,600. And then we would debit the income summary. Before, in a sole proprietorship, when you did closing journal entries, you debited income summary and credited one capital account, one owner. Now you have to distribute those profits. Same with withdrawals. When we're closing withdrawals and we have the withdrawals defined for us, Loisel's withdrawals were $41,000, and each partner would have their own withdrawal account. We'll credit Loisel withdrawals $41,000, debit her capital account, reduce it. She took that money out of the business already. Do the same thing with Randall. Credit his withdrawals account, debit his capital account. Okay, so that's just demonstrating how we allocate profits, how we close out withdrawals, and set up the partnership. So that was 12-24A. In 12-26A, moving along, we're going to admit a new partner. Admitting a new partner. This is on page 675. In this partnership, George, Murphy, and Lincoln, a partnership. They're considering admitting Thornton as a new partner. On July 31st, all the capital balances of the three existing partners and how they share profit and losses are below. We need to make journal entries under each of these independent situations. So let's look at requirement 1. Thornton, the new partner, pays Lincoln, one of the partners, directly for his partnership interest. Okay, so Thornton hands Lincoln $174,000. He doesn't hand the partnership any money. So this is a private purchase. What does the company do? They remove Lincoln as an owner by debiting his capital account for its balance and give Thornton that balance now and credit Thornton capital $130,500. The partnership didn't receive any kind of assets here. So all they're doing is transferring the capital balance from the old partner to the new partner. In P12-26A Requirement number 2, the information given is that the partnership capital before admission of new partner Thornton is $261,000. Thornton contributed $87,000. Whenever an owner puts more assets into the business, it automatically increases equity. So the new partnership capital is $348,000. Thornton was also given a 25% or 1/4 interest in the partnership. So to determine how much we credit his capital account for, we take 25% of the new total partnership capital balance. It just so happens that the cash Thornton gave equals the capital he's going to receive. So on July 31st, when Thornton is admitted as a new partner, debit cash $87,000, credit Thornton capital $87,000. This could change. Let's take a look at number 3. Now he gives $87,000 and only gets a 1/6 interest. We go through the same computations because the partnership's getting an asset. They're getting $87,000 cash. There's 3 partners before, now there's 4. Take the $261,000 capital balance, and we find it the same way as we did before. One more time, on page 675, you take the $43,500 from George plus Murphy's $87,000 plus Lincoln's $135,500. Add them all up, $261,000. Whenever that new partner or any partner puts money into the business, it always increases capital. Increase $87,000. So the total amount of partnership capital overall is $348,000. He agrees to take a 1/6 interest. So 1/6 of $348,000 is $58,000. So his balance in his capital account is only going to be $58,000. He's willing to give $87,000 in cash to the partnership and only have a capital balance of $58,000. If he left the partnership tomorrow, he can only take $58,000 with him. That's his balance in capital. Why would you do that? He really wants to be a partner in this partnership, and he knows the partnership will be profitable and he'll get that money back. And that's why people will do this. Now, what about that difference? Because we're going to debit cash $87,000, credit his capital account for only $58,000. We still have $29,000 that needs to go somewhere. Well, when this happens, when the new partner pays more than their interest, they're really bonusing extra money to the partners, to the other partners. So they're paying off the other partners, if you want to look at it that way. How much? In total, $29,000. We'll distribute that $29,000 based on their profit and loss ratio. So capital George will go up by 20% of $29,000 or $5,800. Murphy's capital will go up by 25% of that $29,000 difference, and Lincoln's capital 55%. So they get that extra money put into their capital account that was given by Thornton. Pretty nice deal, huh? But Thornton said, hey, I want to be in the partnership. That's cool by me. And that's how that happens. In requirement 4, Thornton is giving $87,000 as a contribution, but now only receiving a third interest. I shouldn't say only because it's really better for Thornton. Let's take a look. He gives $87,000 in cash. The old capital balance in total is $261,000. He contributes another $87,000 of owner contribution. The new capital balance is $348,000. How much of that $348,000 can Thornton credit to his capital account? Well, a third of it, or $116,000. So he's receiving more capital or ownership interest than he gave. This is called bonusing the new partner. And why would this happen? Well, maybe the old partners really want Thornton in their business. He's going to do wonderful things for their company, make them a lot of money. So what they basically say is, we'll give him some of our capital balance to get him into our partnership. So the day he's admitted, they debit cash for the amount Thornton gave, $87,000, credit his capital account $116,000, and then decrease their respective capital accounts by their current profit and loss percentages. So the difference of $29,000, 20% of that reduces George's capital. Murphy's will be reduced by $7,250 and Lincoln's by $15,950. So they essentially transferred that much of each of their capital balances to Thornton. In requirement 12-27A, and I do have to apologize, I'm re-recording this if you haven't noticed, and I just want to get the answer key out there for you. I don't have the book in front of me, so I can't read the requirements. You can though. In this, we purchases Hose Capital. Okay, so it's not of a new partner coming in from the respect of there was 3 and now there's 4. No, there's 3 before and there's 3 after. So when we buys Hose Capital balance, might pay them a higher dollar amount than $35,000. But what happens on the partnership's books? Hose Capital is debited for its current balance and We's is credited for the $35,000. Okay. In the second part, how do they account for the withdrawal of Ho from the partnership? Well, they promised to give Ho cash of $10,000 and a loan or notes payable from the partnership for the remaining $25,000 balance in his capital. So they'll debit Ho's capital for the $35,000, credit the cash in the partnership $10,000, and credit notes payable for the other $25,000. So that's how we would do the accounting for 12-27A parts 1 and 2. In requirement 3, the partnership agrees to pay Ho $65,000 for her book value in equity, which is only $35,000. Okay, why would they do that? Maybe they really want her out of there. We'll take a hit. We just want her gone. She's terrible. Okay, there's many different reasons, but think of it that way. So they're going to credit cash. They gave her 65 grand. Don't let the door hit you. Get out of here. Debit capital Ho. She's gone. There's only 2 partners left. They have to eat up that difference that they gave her. And so it's treated like they withdrew the money themselves. So we debit their capital account for their remaining profit and loss ratio that's still left. So if Kim gets a 40% profit, Ling gets a 30% profit, we could say, okay, so that's 40% plus 30%. You can look at it that way, is 70%. So 40 of the 70, so 4/7 of the 30,000 will be debited to Kim's capital, and then 3/7 of the $30,000 difference is debited to Ling's capital. Okay, and then in the final, Ho leaves taking only $25,000 for her book value. Maybe Ho says, I need to get out of this partnership. Just give me 25 grand. I don't want to be here anymore. I'll take the hit. They debit her capital account, $35,000, only 2 partners left. They only have to give her $25,000. So she essentially is handing those other 2 partners that $10,000. She's saying, I don't want it. You guys keep it. So what do they do with it? On that same ratio basis, they increase their capital accounts accordingly. Okay, so withdrawals are very much a lot like admissions. You could bring a partner in, they can contribute more than you give them, bonusing the partners that are in there, or you can have them bring less in than you give them, and you're willing to give up some of your capital balance as the other partners. And the same with withdrawing from a partnership. Okay, so those were the problems I wanted to review for Chapter 12. If you have any questions, post them to the discussion board or email me.